Welcome back to our intermediate financial accounting class. For those of you who may be joining us for the first time, my name is Jason Porter, and for the last 8 years I've been an accounting professor teaching this very class, and I love it. The journal entries, the transactions, the workshops, the tables, all the different elements of the financial statements that all come together so beautifully to create a set of information that investors can use to decide whether or not they really want to buy or invest in other ways in a company. In this lecture, we get to talk specifically about different kinds of investments. So it's doubly important for us since it's not only about investments, but it helps us to see how we can use the information that we've been putting together. Before we jump into our discussion though, let's take just a minute and talk about where we are in the class. If you remember, we broke the class down into 3 different modules. The first was about the accounting cycle. The second has been about assets. And over our last couple of lectures, we've been talking about property, plant, and equipment. That means that we're just about done with this module. Now, unfortunately, we can't talk about every single asset, just some of the major assets and the ways that we account for some of the more advanced transactions that are involved in recording assets. So for this lecture, we're going to focus on investments, trading and available for sale securities, and then equity securities that companies can buy. Now, why do we care about this? Well, investments are becoming a more and more important part of the business world all the time. It used to be that companies focused almost solely on whatever their core competency was. But now companies are diversifying through sales and mergers and acquisitions and diversifying their business. And part of that includes buying out rivals by purchasing their stock. In addition, companies now are often planning a little bit more carefully for their future expansion, which means they're trying to save up money so that they have the funds they need to expand, or to handle a pension, or to repay debt. And the purchase of investments is one of the ways that companies can save up the resources that they need for these future plans. Companies may choose to buy stock in other companies for other reasons, not just to save, but also to control their supply of raw materials, to be able to increase demand for their products by buying stock in one of their customers. They also might decide to merge with a rival or create a stock portfolio that will allow them to mitigate their risk. In addition, companies will invest in bonds and other commercial paper, different kinds of debt. This allows them to avoid volatility in the stock market. It allows them to ensure cash flows over time if they're buying a security with a series of payments, or even just a lump sum at the end. In addition, the bond market allows them to finance subsidiaries or parent companies that may be having trouble. And of course, we need those companies in business so that we can stay in business. So providing them with debt financing is a way that we keep these clients or these customers or these suppliers or our parent company or our subsidiary company in business so that they can grow. From an investor's point of view or a manager's point of view who's trying to do an assessment, understanding the classifications of investments allows us to understand what a company is trying to accomplish with its investment strategy. If we know where they're putting their securities and the kinds of securities they're buying, then we have a better insight into what they're doing. We also have a better insight into the kind of profit they're reporting or not reporting, because some of it doesn't get reported, but it's important all the same. So we want to be able to know where to look for these different kinds of profit so that we can use them in our analysis of a company's progress. Investments have become such big business that we see almost every company now making some kind of investment decisions. And most of us are making investment decisions as well for our retirement or saving up for a vacation or to buy a new car or to put a down payment on a house. These are really important issues. And while we won't focus on the decision side, how do we decide whether we want to do this or not, we are going to focus on what investors see and how we can assess them. And that's important for us. And it all starts with understanding how accounting and GAAP break down the different styles of investments. The first way FASB breaks down investments is the same way that you and I would break them down: debt versus equity. And when we're talking about debt versus equity, we're typically talking about bonds as the primary kind of debt that you can buy on the open market, although there are other types. Or we can invest in stock. That would be our ownership. So we can buy shares of voting right stock or common stock, or we can buy shares of what we call preferred stock, which gets a preference in dividend. We split them up into these 2 main categories because, of course, the returns that we get and the way that we make a profit is very different under the 2 methods. Stock investments make their returns primarily through dividends and, of course, through selling the stock later on. Debt investments make their money primarily through the payment of interest and then the eventual repayment of the principal. And like stock, bonds can be traded on the open market as well. So we can make money by simply trading the bonds to somebody else. Because they have fundamental differences in the way that they provide returns, the accounting is naturally very different. Let's start with stock investments. We have two main categories of stock investments. The first is what we call fair value investments, and the second are equity investments. Now, a fair value investment is an investment that we are holding to sell eventually. So we're not trying to control the other company. We don't really want the voting rights. We're just buying stock on the open market, and later on we're going to sell it. And we can actively trade these securities, meaning we have an investment department and they're making decisions on when to buy and sell, and we do very active trades. Or we can hold them long term. For example, if we're saving up to pay off a pension or to repay some debt or to expand our business. Either way, we record these investments for eventual sale at their fair value and classify them as fair value securities. The other option with stock investments is purchasing for the vote. We want to control the other company, and we cleverly call these equity investments. Both types, fair value and equity, are equity, right? We're buying stock. But with equity investments, we have purchased them for the equity, for the voting rights, for the control. And so we account for those investments based on our control of the company, as opposed to the fair value investments, which are accounted for using fair market value because we are actively trading them. Next, let's talk about debt investments. This time we have three different categories. The first two, trading and available for sale, are sort of like the fair value for our stock investments. We didn't buy them for the normal purpose. We didn't buy these bonds in order to get the interest revenue and then the eventual repayment of the principal. We bought them to trade them. A trading investment we bought to actively trade. Think day trader. An available for sale bond or investment is one that we're holding for a long-term purpose. So I purchased this bond, I'm going to save it for 2 years, and then instead of waiting for them to repay the bond, I'm going to sell it to somebody else in 2 years when I need the cash to repay my own debt or to do some expansion. So it's like a long-term fair value investment that we might have in our stock. Now, during this time that we're holding a debt classified as trading or available for sale, we'll get our interest payments and we'll record interest revenue and we'll amortize away any premiums or discounts. But we're still going to keep track of them at fair value, just like we do for stock investments that we've held for the purpose of resale on the market. Because that's our goal. We intend to sell them on the market, so we're going to keep track of their value on the market. A held to maturity debt investment is like the notes receivable that we've already studied. We're holding them to get the interest payments and then the eventual repayment of the principal. That's an overview of the different kind of classifications. Now let's walk through some details. Let's start with our stock investments. First is the fair value category. And again, these can be short-term or long-term. Either way, we track the fair or market value on our balance sheet and record any gains or losses on the income statement. Now, this was actually a big debate for a long time because some people said, wait a minute, you haven't actually sold these stocks, so why would you record a real gain or loss? You haven't made or lost anything. It's only a change in value. You shouldn't record this on the income statement until you actually sell it. Well, FASB said, you're right, they haven't actually sold it yet, but because we can track the fair value, the market value of these securities, we can see if they've made what we call an unrealized gain or loss over the period, meaning the stock price has gone up or down and they are now worth more or less, even though we haven't sold them yet. And they can show that value on the balance sheet. Well, this was revolutionary. We don't record most assets at their fair value. We record them at historical cost. But because stock prices are so easy to see, FASB wants us to record that fair or market value on our balance sheet. And then because of that, we're recording any gains or losses period to period on the income statement. More traditionally, we have what we would call equity securities. This is a really hard name for most people because all of these stock investments are equity securities. They are stock in another company. But we only call them an equity investment if we actually are controlling the other company. And that's what differentiates it from the fair value stock investment. So fair value are stock, but we don't want control of the other company. We just want to trade them on the open market. And equity securities are stock that we want to control. And in order to classify as an equity security, we have to have what FASB calls significant influence, which means we have a substantial say in the way that company does business. Now, the easy definition of significant influence is 20% or more of the voting stock. That would be significant influence. I own a really big chunk of the company's vote. However, I can also have significant influence if I have a seat on the board of directors, or if I'm the only active shareholder and most of the rest of the stock is being held by retirement funds where nobody actually votes. So there are different ways that we can show that we have significant influence, but the easiest and the one that we're going to focus on is this 20% threshold because it's the easiest to observe. The way that we record equity securities is very different from fair value securities. We will record this investment at fair value until we hit that 20% threshold or that significant influence rule. But once we cross that threshold, then we stop recording fair value and we start recording our share of the change in their retained earnings account each period. So if you think about a retained earnings account, it goes up because of net income. It goes down because of a net loss. It also goes down because of dividends. So when any of those three things happen, they show a net income, they show a net loss, or they pay a dividend, then their retained earnings will change. And when their retained earnings changes, so does our account balance, because we are now tracking our portion of the changes in their retained earnings. The balance sheet value is going to be the sum of what we invested in the company, plus or minus our portion of any changes in their retained earnings account. On the income statement, we will show our portion of their net income or net loss. Dividends are going to be a debit to cash and a credit to our investment account. A net income or a net loss will be a debit or credit to our investment account and a gain or a loss. All of this continues until we cross the 50% threshold. If we own more than 50% of the subsidiary, then we now control them. Nobody else can change what we want that company to do. We have the majority of the voting stock. And so the rule is, at that point, once you cross that 50% threshold, then you consolidate their financial records into our financial records, or we add their assets and their liabilities in with our own, because we control that company. They're our subsidiary. And that's a whole other process. We don't have time, unfortunately, in intermediate accounting to talk about all the details of consolidations. But I will warn you, it is a big part of the CPA exam. So if you're getting ready for that test, you might want to take an advanced financial accounting class or take some extra time learning how to do consolidations. And that's how we account for stock investments. Now let's talk about debt investments. Again, we have three different categories here. The good news is the first two, trading and available for sale, is very similar. Both of them require us to put the fair market value, so what these bonds are trading for on the open market, on our balance sheet. And to offset that journal entry, we would also show either a gain or a loss. The difference is where we put the gains and losses. If they're trading securities, then gains or losses go on our income statement, because under FASB's logic, you're trading them. Therefore, any benefit is due to what you did. Any loss is due to what you did. That's income statement. So we put it all on the income statement. Available for sale securities, on the other hand, we're really just buying and holding until we get to whatever it is we're saving for. So since we're not actively trading them, companies made the argument we shouldn't be on the hook if these go up or down in value because we aren't doing anything about it. And FASB agreed with that. So what they have said is, gains or losses go into what we call comprehensive income instead of net income. So these are OCI accounts, other comprehensive income. They show up in a separate statement of comprehensive income and go into the balance sheet down below retained earnings. We won't show any gains or losses on the income statement for available for sale securities or debt until we actually sell them. And then we'll show the real gain or loss on the income statement. But until then, gains or losses hit other comprehensive income instead. Finally, we have our held to maturity securities. We have purchased these for their cash flows, the interest revenue coming in and the repayment of the principal. Just like with notes receivable, we record these at their amortized costs or net present value. This is defined as the face value or fair value plus a premium or minus a discount. So if we bought them at a little above their fair value, we would record a premium when we initially bought them. And so we take the face value plus however much of that premium we have not amortized away. If we bought them at a discount, so we bought them a little cheaper, then we'd take what the face value that we're going to get eventually when they repay the debt minus what's left of the discount. And our interest revenue each period will go on the income statement, and it will include the amortization of premiums and discounts. Wow, lots of information, isn't it? There's just so much to take in with investments because they're very different from all the other assets we've talked about. But you can get it. It's going to be very easy as we walk through it step by step, and that's what we're going to do next time as we pick up with an example. I'll see you then.